Trading binary options involves predicting whether the price of an asset will rise or fall. Successful traders have a winning percentage high enough to make them profitable. Identify the trend by looking at a chart and selecting the right option type. For example, if you see an uptrend, invest in a high option. If the trend is downwards, invest in a low option. Breakaway gaps. When prices move quickly through a price level, it can cause a gap. Gaps can be a sign of a change in market momentum or a technical breach of support or resistance. They may also appear after the completion of a key pattern, such as a consolidation range or a trend line. In addition, they can occur as a result of news events that influence the market. These events include the release of earnings reports or speeches by central bank officials. The most common gap is an overnight gap, which occurs when a stock opens significantly higher or lower than the closing price of the previous period. This type of gap usually results from a large imbalance between demand and supply. For example, a company's earnings report may be better than expected and encourage traders to buy the shares. Alternatively, a negative report might prompt traders to sell the shares. There are several different types of gaps in the market, and each one can give you a unique opportunity to trade binary options. Breakaway gaps are usually accompanied by high trading volume and indicate that there is strong momentum behind the movement. These gaps are often the best place to invest in a binary option. Acceleration gaps are a little more tricky because they don't always fill. However, if the gap is followed by an acceleration in the direction of the movement, it's likely to close. In this case, you can use a one-touch option with a target price inside the gap. Closing gaps are another type of gap that can provide opportunities to trade binary options. These gaps usually appear near the end of the trading day, when most traders have closed their positions. They can be a great source of profit because they can be traded with an expiry that's accurate, and the gap size provides a clear target price. This strategy is ideal for traders who can't trade during the day but still want to make a profit. Acceleration gaps. Gaps are price jumps that occur when something radically influences the market. They are usually accompanied by a high volume and happen when there is strong momentum in the direction of the gap. They can also happen at the end of a trend. These gaps are referred to as acceleration gaps, and they are ideal for trading one-touch options. However, if the gap is not backed by enough traders and is accompanied by low trading volume, it is likely to close. This is a sign of exhaustion and an impending reversal. This is why it's best to trade these gaps with an expiry similar to that of the previous trend. Middle Bollinger Bands. The middle Bollinger Bands are a useful tool for traders in uptrends and downtrends. Traders can use the upper BBs as upside targets to trim some or all of their exposure by selling into strength, and they can also use the lower BBs as trail stops to reduce the risk of a short position. This approach can help to limit the wild fluctuations in a trader's account balance. The bands adjust to volatility and can widen or narrow depending on the market's momentum. If the price of an asset moves outside of the bands, it is a sign that there is more potential for volatility to increase. However, if the price moves inside of the bands, it is a sign of decreased volatility. When prices move outside of the bands, it is a warning that the price may be overbought or oversold. Overbought conditions can cause a price correction or a slowdown in momentum, while oversold conditions can lead to a rebound. This is because the bands are based on the concept of mean reversion, which suggests that over time, an asset will tend to return to its average or mean price. In addition to recognizing overbought or oversold conditions, traders can also use Bollinger Bands to identify volatility. Typically, periods of low volatility and steady or sideways prices, known as contraction, are followed by periods of expansion. A contraction period is a great indicator that a trend is about to change, while an expansion period is a signal to buy. Bollinger Bands can be used in combination with other indicators to improve trading accuracy. For example, combining them with the Relative Strength Index, RSI, can help traders recognize trends that are stronger or weaker than others. Traders should note that Bollinger Bands do not work well in all markets, so they should try a few different configurations to see which one works best for them. Using Bollinger Bands is an effective way to predict future price movements. Traders can use them to identify overbought or oversold conditions, find out when the bands are expanding, and set prices based on mean reversion strategies. They can also use them to detect trading ranges, which can be useful when trading ladder options. Long-term trends. Following trends in binary options is a secure and simple strategy that even newcomers can execute. This is a way to maximize your profits while minimizing your risk. Trends are long-lasting movements that take the market to new highs or lows. One of the most important aspects of this type of trading is determining whether you are going with the trend or against it. If you are going against the trend, your expiry must be more precise because you will need to wait for an extended move counter to the trend to end your trade in the money. In contrast, if you are going with the trend, you can use a longer expiry because the movement will likely have more momentum and you can be more confident that your trade will end in the money. There are many different ways to identify trends. Some traders use technical indicators such as the money flow index (MFI) to help them determine which direction a market will move in. Others rely on candlestick formations, which can provide short-term indications of future price movements. Whatever method you use, be sure to match your indicator to a suitable time frame and choose the right binary options type. For example, if you are predicting that prices will rise, invest in a high-low option with an expiry that is 2 or 3 times as long as the cycle length. This will ensure that you will have enough time to close your position if the market reverses its direction. Similarly, if you are investing in a retracement, be sure to invest in a binary option with a low expiry. This will allow you to avoid a big loss if the market retraces too far and loses its momentum.